Hey everyone, this is Ben Morales, your personal financial consultant and coach, and welcome back to my channel. And I have a question for you today. Are you someone that within the last 2 years you purchased a home and you used the FHA loan to get that home? If you are, then you're most likely it's somewhere of an interest rate of maybe 6.5 to 7%. And now you are frantically and anxiously waiting for the interest rates to go down so that you can refinance your loan, so that you can help eliminate some of the costs, like particularly the mortgage insurance premium, and hopefully get yourself into a lower rate. Well, if you stay with the traditional route, if you try to then refinance into another FHA loan, what they call Streamline, it's not going to be as advantageous possibly as you thought. So today I want to share a different way of doing that where we can actually more quickly and efficiently pay off your mortgage debt and save you some money while you're doing it as well. So I'm going to show you a scenario, and the scenario we're going to look at is someone who purchased their home in 2022, and the purchase price in this scenario is $300,000. So the 3.5%, most people that purchase a FHA home, they do it because it allows you to only put 3.5% down, which on paper sounds like a great deal. You can get into your home. A lot of people leverage that to buy their first home, but there's upfront costs and annual costs that are involved when you do that with an FHA loan. So this particular loan, the example that we're using, we're talking about a loan that is at 6%. Your rate might have been higher or lower. The principle is the same. You're still going to end up putting, most cases, a 3.5% down to help offset the cost. But when you do that, you got to keep in mind, anytime you put less than 10% down, you're going to have what's called an upfront MIP. It's a mortgage insurance premium. That premium covers the lender for the likelihood, just in case that you do not pay off your loan or you default on the loan, rather. And what happens, that is a percentage of the loan amount based off your down payment. In this case, 3.5% is the down payment. So you're going to be looking at a 1.75% is your upfront MIP. And then your annual MIP is going to be an additional cost to you. And that cost is going to be $132.69. And that, unfortunately, is going to be for the life of the loan. So when you do an FHA, if you keep in mind, if you do not put 10% down, especially if you're in the market potentially to buy a home and you're thinking about going FHA, keep in mind, if you don't put 10% down, then you are going to be forced to pay an annual MIP, which stays there for the life of the loan, even if you were to refinance into another FHA type of loan. So we'll talk about that a little bit later. So according to calculator.net, let's look at what the breakdown of all of this looks like. Okay, so the principal and interest, you're looking at $1,767.18. Now, I will say, because it's an interest rate that we're using of 6%, you're looking at the first 3 years, right, from 2022. So the first 3 years, you're going to be paying anywhere between 81 to 85% of that payment is going to go toward interest, right? As the years go by, less of it will go toward your interest. But at the beginning, it's about 85% of your payment goes to your interest. And by the third year, you're down to about 81%, meaning that about 200 and maybe 30-ish, $225, $230 is actually affecting your principal. So again, we're using a hypothetical situation here where from 2022 moving forward 3 years, what this would look like. So in this calculation as well, and by the way, this is all based off of calculator.net. You can go to calculator.net and you'll see exactly what it looks like based off this particular scenario. $500 is going to go toward the taxes, and then we're going to look at the MIP as well. Right, the MIP is here, and we also have to include the homeowner's insurance, which when we total it all up is $2,524.87. So now you've been anxious, you've been watching the news, you've been keeping the tabs on the market. You are waiting for that moment where your home is going to be at 80% LTV, so that now you could refinance your loan and get rid of this $132.79, which is going to be there to the life of the loan. And by the way, if indeed you left that on there, you're going to be looking at an extra cost of about $47,000. Let me just check my notes real quick. $47,767.50. That is going to be the additional life cost for that loan if indeed you leave it there. And even if you were to refinance at the FHA, it's going to still show up again because you started the loan with less than 10%. So how do we fix that? If we look at it, in the 3 years that you've been making payments from 2022, you would probably be down to a balance that you owe now of $283,288 rather, $283,288. Now, if we fast forward, right, most homes since 2022 have gone up minimal, at least 18%. So let's do the math on that. If you started with a home value of 300,000, right, and your home went up 18%, your new home value now would be about $354,000. So we take the 354,000 and we look at the current balance right now, right? Over the last 3 years you've been making payment, you got that balance down now to 283,000. Well, if we did that, we can see that gets us exactly where we need to be, which is 80% LTV. So now in your mind, you're ready to pull the trigger. You're like, okay, I'm going to go and apply for a loan. I want this eliminated so that I don't have to pay for an extra $47,000 over the course of the next 30 years. So typically you would want to go ahead and do an FHA loan, possibly, or you have the other option, which if you did an FHA loan to try and refinance this, unfortunately, you would still be stuck with some kind of mortgage insurance premium because you did not put at least 10% down when you started the loan originally with FHA. That means what? Well, the only way then to eliminate that extra $132 is to do what's called a conventional loan, right? Well, a conventional loan, now that you're at 80%, will allow you to do that. The problem with the conventional loans right now is those rates are going anywhere between 7.5, maybe to 7.95 for a 30-year. If you do a 15-year, you might get it a little bit lower. But my point is, you're almost right exactly where you started off again. So yes, you're going to be able to get a similar type of rate. You're going to be able to eliminate the $132 extra that is going to your mortgage insurance premium. But what if there is another way? What if there is a more efficient, more more way, or I don't even know if I said that right, but if there's a more efficient way to be able to eliminate this off and start paying down that mortgage? Well, there is indeed. Now that you are at 80% LTV, and if you don't know what that means is how much is your home worth in comparison to how much your balance is on the mortgage that you own. Whenever you're at an 80% loan to value, right? This would be your loan and there's your value. You reach that 80%, that is going to open doors for you, like in the FHA loan, give you the ability to remove that. But the better way to do that is get yourself a home equity line of credit. Why? Well, home equity line of credit, when you are at an 80% LTV, when you go to a lender and you ask them for a home equity line of credit, that's one of the questions they're going to ask you. When they see that you are at 80% LTV, in other words, what you're asking for from a borrowing standpoint is only 80% of the value of the home, you're going to get a better interest rate. If you're looking right now, or if you start to search right now, there are certain banks and there are credit unions that would allow this. One of the credit unions that, by the way, they did not sponsor this channel, but in my research, I discovered that there's a credit union that will offer 4.9 interest for 12 months. Okay. That credit union is Consumers Credit Union. Okay. You can open up an account with Consumers Credit Union. I think all you need to do is open up a savings account and put a deposit in there. And then you could actually apply for a home equity line of credit. And again, because you're going to be at 80 LTV, if your credit score is strong enough, you can actually qualify for that 5.49%. Now, why is that important for you when you're trying to eliminate that MIP cost and when you're trying to more quickly and efficiently pay off your mortgage? Well, when you do a HELOC, there's things that you do not have to pay in the same way that you do have to pay when you have a what's called escrowed loan. That's what this is. You make one payment. This is your one payment here. Okay, this payment goes into an escrow account where they collect your principal and interest, your taxes, your mortgage insurance premium, and your homeowner's insurance. So every month you send that money to the bank, and then the bank starts to disperse this as they need to. So having a home equity line of credit, you will not have to do that anymore, which means for you, improving your cash flow, that's a beautiful thing because you can take your cash flow now and apply that to the actual principal and only pay those bills when they are due. You could actually change those bills and pay them on a yearly basis instead of a monthly basis, like you can with homeowners insurance. So what do you get back by going into a home equity line? You're going to get a lower interest rate. Okay. You're also going to get back $132 because you're going to eliminate the mortgage insurance premium. You're going to eliminate, right? Because we're not going to send it down on a monthly basis. What we're going to do is we're going to use those extra funds and put it toward paying down the loan. We're also going to do the same thing with the taxes. So let's see what we get back. We get $500 for the taxes. We get $132.79 for the mortgage insurance premium. And we're also going to get an additional $125 back for the insurance. So in total, on a monthly basis, just by getting a HELOC, transferring that principal that you owe, $283,288, into the HELOC, you are getting back cash flow of $757 back that you can just apply right back to paying off the HELOC, right? And so, folks, that's how you do it. It's about putting your money to use for you first and not leaving it in places that it is doing nothing for you. When you leave your money in an escrow account, what their bank is doing is they are investing it into other things. They are putting it to use for them. So let's reverse that. Instead of leaving it up to the bank to do it, let's take charge of it. Let's take control of it, and let's put it to use for ourselves now. And so if you need more help or more information about how to use a home equity line of credit and to put this into place for you, then I encourage you to watch one of my videos called Discovering the Best Way to Pay Off Mortgage Debt. And it explains step by step exactly how you can leverage a home equity line of credit and help you do exactly that. So with that, I want to leave you. I want to thank you so much for your continued support. Continue to like, subscribe, share, and comment below. I try to respond to all my comments just as quickly as I can. And I thank you for tuning in today and to the next video. Take care.